just about ready to go. So let me click into our first slide here and just kind of welcome everybody. So thanks for joining us today. My name is Will Simons. Pleasure to be with you virtually. I'm going to say hello on camera here for just a moment, but be turning my camera off during the class itself, just so everyone can focus on the actual slide material that we've got today. So thank you all for joining us. Those of you who have been with us the last couple of months, you'll know this is part of a monthly series of webinars that we do at Association Reserves. Typically, this is the first one in the series. This is called Fundamentals of Reserves, which is then followed by Reserve Funding Methodologies. So that'll be on tap for next month. It's always the same timeline. I think it's the third Tuesday of each month. So you'll be getting follow-up emails with invitations to those as well. The third webinar in our series is always called Ask a Reserve Specialist. So that is not a CEU credit, but that is just an opportunity for anybody to sign in and ask questions of a professional in the field. That can be anything about budgeting, about reserve studies, about legislation, about anything under the sun that we might have an opinion on. So stay tuned for that one. The next Ask a Reserve Specialist will be on tap for July. So let's switch back, talk about today's class. This is called Fundamentals of Reserves. Should go for about an hour, followed by that time for Q&A at the end. As we always say, usually we have a lot more questions that come in than time to answer them. So apologies in advance if we don't get to your question, but you can always email us after the fact. I'll have my email address up on screen at the end. We'll try to get through as many as we can today. And as I mentioned, you can go ahead and start submitting those questions now. If you look down at your Zoom taskbar, there's a button that says Q&A. So if you have a question you'd like us to address at the end, please feel free to do that. Some of the questions that people ask will naturally be answered by the material that we're going to cover over the course of this next hour. So if it's something that we do happen to answer, if it's a question about, what is a reserve component, something like that, probably just kind of recommend that people go back and watch the recording, just in the interest of time, because inevitably there will be questions that are not covered during the material, and we kind of want to focus on those. But feel free to start asking those questions whenever you like. Another quick reminder, just in case we have any technical difficulties, it's only happened one time, but if the power goes out, if the internet drops out, please try to stay in the class as long as you can. If we can get reconnected and sign back in, we'll do that. Otherwise, we'll send a follow-up email to let everybody know that we'll have to try again another day. As another reminder for all the CAMs, all the licensed managers attending today, this is good for 1 hour of course credit. So we'll be recording those credits and reporting them to the DBPR within the next week or so. If you want to check that just to make sure, you'll see that posted to your accounts here pretty soon. This is going to be 1 hour of IFM, Insurance Financial Management Credit, which you can also record this as an elective. So I'm going to switch my camera off now just so we can get started. And again, thanks for joining us. Okay, before we dig into the course material, I'll take a moment to introduce myself and our company in a little bit more detail. My name is Will Simons. I'm the president of the Florida office for our company, Association Reserves. I've been with the company since 2008. I've completed and overseen, I should say, over 3,000 reserve studies in my career. The RS after my name stands for Reserve Specialist. That's an industry-specific credential that's only awarded to people who have demonstrated their experience and expertise in preparing reserve studies. The designation itself comes from the Community Associations Institute, CAI. As of right now, we have 5 reserve specialists on our Florida staff, but a few dozen more spread out amongst our other offices around the country. I've lived in both condos and HOAs and spent about 6 years serving as the treasurer of my own HOA in South Florida, where we had a budget there of a little over $1 million. The reason that I point that out is because I know what it's like to be on the other side of the table. Okay, I know it's a thankless job, and I salute those of you who are out there doing this every day, every week, every month, doing what you can to try to make life better for your communities. So if you board members that are joining us today, you're not here for credit, you're just here for information. We really appreciate that very much. So thank you. Today, I'm also joined by Guillermo Estanos. Guillermo is one of our project managers here in our Florida office. He received his degree in civil engineering from Florida International University. and is also currently working towards his MBA from the University of Florida, as well as his reserve specialist credential. So Guillermo, thanks for joining. Pleasure to have you with me today. Who is Association Reserves? Very simply, our company is the oldest and largest reserve study provider in the United States. And we've been in this business now since 1986. And we've completed tens of thousands of reserve studies for all different types of properties all around the world. We have offices from coast to coast, and I believe we have more credentialed reserve specialists on staff than almost any other company. The majority of the work that we do is for community associations, which includes all types of condos, HOAs, timeshares, other residential communities. But we also have a great deal of experience with other property types, things like office buildings, hotels, resorts, worship facilities, and more. We're very lucky, been very fortunate to be recognized with the Reader's Choice Award for the last 10 years in a row by the Florida Community Association Journal. One thing I always like to point out is that our only job as a company is preparing reserve studies. Okay, we are not an engineering firm, we're not an accounting firm, but rather a specialized consulting firm, which is focused on doing this one thing really well, which is to guide our clients towards a successful financial future. The way that we do that is by preparing accurate and reliable reserve studies that help our clients to forecast and budget for major projects. So if we do our job well and our clients follow the plans we help them design, then they should be able to reduce the risk of special assessments and bank loans and other types of financial distress. If you'd like any additional information, you can visit our website. It's right down here in the bottom right, reservestudy.com. Or you can also email me. I'll have my email address up on screen at the end during the Q&A. But if you want to jot that down now, it's wsimons, WSIMONS, @reservestudy.com. Okay, so this is what we're going to cover today. This course primarily just has these two sections. We'll spend a little bit of time in the beginning answering this kind of basic question, what are reserves? Then we'll spend the majority of the class reviewing reserve studies and how those documents are used by community associations to make sure they're on the right track with regard to long-term planning. Our next section, I should say, I kind of left it off the menu today, but a secret item on the menu is right at the very end. We're going to talk about Senate Bill 154, right? So I know there's probably a lot of people here who are very curious about the most recent legislation, and definitely wanted to spend a little bit of time on that. So I have 3 or 4 slides at the end where we'll talk about what has happened most recently in the conclusion of this legislative session, which just ended about a week and a half ago. And I'll give you kind of a preview of what's to come there. But again, feel free to take notes. The slide material will be shared with everybody. So we'll get started here in just a moment. Before we do that, I like to include this slide in every presentation that I give because I think this illustrates a very common reaction or mindset when it comes to long-term planning. Okay, so what we see out there, what I'm sure you've seen amongst your community members, is this sort of reluctance to embrace the responsibility of long-term planning. And I think this guy here represents a very typical attitude that we see when it comes to thinking about this stuff, about budgeting for reserves. If you look at him, he's got his eyes closed, fingers crossed, kind of this pained look on his face. So if there's one message I want you all to remember from today's class, it's that we all need to go out there to the communities that we work with, try to help them get over this mindset. Okay, it's our responsibility as professionals in this field, whether you're a reserve study provider, a manager, or a volunteer such as a board member, to educate the people around us, not let excuses get in the way, and help the people that we serve to take action. Okay, I'm going to hand things off to Guillermo at this point. He's going to get us started with our first section.
Okay, good afternoon, everybody. Thank you again for joining us today. Let's begin with by answering this basic question. What are reserves? Now, for those of you that have been in this field for a while, this slide may be kind of elementary, but for those of you that have been, that are newer to this profession or are not used to drafting budget, I think it's a good idea to spend a couple of minutes just talking about what are the main 2 aspects of any given association's budget. Basically, the budget can be categorized into 2 main sections, the operating funds and the reserve fund. First, let's talk about the operating fund. Your operating money is there essentially for your routine costs. There are going to be your daily, weekly, monthly expenses for things like utilities, insurance, payroll, preventive maintenance, and so on. If you want to think about it in personal terms, you can think of the operating account as your own personal your personal checking account. Your operating funds are unrestricted, which means that you can spend that money on any bill that the association has to pay. And the money is normally going to be spent in the same year that you collected. So meaning if you have a design good budget, you shouldn't have any surplus or deficit at the end of the year, and you spend all the money that you collect within a given fiscal year, during the same year. On the other hand, you got your reserve account. Now, your reserve account or accounts are therefore long-term expenses that the association will have to pay for. Some of those expenses may not occur in 5, 10, or even 25 years at a time. But when they happen, they may be some of the biggest bills that the association will ever have to pay. The reserve funds are typically going to be used for things like roof replacements, painting buildings, pavement resurfacing, and any other projects that we'll talk about later during the presentation. Some of the other differences between operating and reserves are that reserves are restricted, which means that once you put $1 into a reserve account, it can only be spent on specific things, not on any random project or cost. Another difference is that in contrast to the operating fund, reserve money will accumulate and build up the account balance until it needs to be spent on a specific projects. Now, going back to our analogy, in that way, the reserve account functions more like a person's savings account. Okay, on this slide, we included a portion of the Florida statutes. We are looking right now at the statute 718, or at least a portion of it, which is also known as the condo statute. Now, what is highlighted in red here is a portion of the text that talks about what associations must be reserving for. So you can take a look at that section of the statutes, and that requires that the condo associations must reserve for 3 things in particular, and they add in one general definition. The 3 things are roof, painting, and paving, and then the general catch-all definition that they have at the end for any other item with a replacement cost greater than $10,000. Now, you may be wondering why they pay $10,000. We've asked this question of many different audiences, and nobody has given us like a clear answer of why the number is 10,000, and they didn't pick $1,000 or $25,000. Nobody really knows. Or guesses that when they wrote the statutes, they just pick a number that sounded really high and went with that. Our point is that the $10,000 number is totally arbitrary. For so many associations, that number is probably too high for the threshold to set. As we'll talk about later in the class, a more appropriate way to look at that dollar amount should be in terms of what is a financially significant number for this specific association. So on this slide, we included a portion of the statute that belongs to HOA. I'm talking about statute 720. That actually has even less to say about what you should be reserving for in a community association. Unlike the condo statute, the HOA one doesn't have any specific shell list of items that needs to be included. Instead, it just says that there are some things that the association is responsible for, and if you don't have reserve for that, it could end up in a special assessment. Now, the good news is that there is a much more realistic and detailed way to go about defining what any association should be reserving for, and we'll talk about in just a little bit. So now I would like you to keep this basic definition in mind. Reserve money is for any association to save over a long period of time for major repairs and replacement projects. Now, keep in mind, we didn't say that you're going to spend reserve money on capital improvements or paying a costly insurance deductible or any other type of projects. For example, let's use an example. Let's consider that a given association doesn't have a playground, but the residents really want to install one. That may be worth it, but they're not supposed to use reserve money for that. That will be adding a new element to the association, and that has never been considered in previous year's budget, meaning that any prior reserve contribution has ever taken that cost into account. In reality, it may be a great thing to do, since that somehow that's gonna add value to the property, but the that initial expense have to come out of the different source. However, going forward, once the playground is actually in place, then the association will need to start reserving for it and thinking of a long-term replacement cycles. But again, the initial investment of installing the playground in the first place will not be eligible for reserves.
Okay, Guillermo, very well done. Yeah, and I want to just, I guess, reiterate to everybody listening today, the two little excerpts that we gave there from the statutes are very brief, and those are the I guess overarching language that is still in the statute. When we talk later on about Senate Bill 154 and which types of properties that pertains to, I want to emphasize that all condo associations, regardless of how tall the buildings are still subject to Statute 718, and that language is unchanged. All condos still need to prepare an annual budget that shows what it would take to fully fund their reserves for roofing, painting, pavement, and anything over $10,000. So that's, there's a lot that's changed in the legislation these days, but that is unchanged. And I just, we'll come back again to the end talking about that what has changed, but just for those of you who are in single story or two-story condos or properties outside of Florida that this is totally not applicable to. I want to just reemphasize that a lot of what we're talking about today comes from National Reserve Study standards and the existing Florida statutes. So let's talk about reserve studies now and how these are used by properties when they actually prepare those annual budgets. So first thing to do is just to establish the definition of the term reserve study, which comes to us from National Reserve Study standards. Now, these standards have been in place now for over 20 years. They were adopted back in 1998, and they state that a reserve study is a tool or a document that does a couple of important things. First, it identifies the current status of the reserve fund. And then secondly, it provides a funding plan that gives guidance about how to deal with future expenditures. Now, again, let's notice what we did not say, right? A reserve study is not an insurance appraisal. It's not a turnover study. It's not an engineering report. It's not a milestone inspection. It's a very particular document that contains very specific content regarding both the physical and financial elements of a community. There are three types of reserve studies. So if a property has never had one done before, then it will need to begin with what's called a full reserve study. So in that type of service, the provider is creating everything totally from scratch. It involves a new thorough site inspection, taking measurements, photos, otherwise gathering up all of the other data that will eventually become the component list for that property. Now, after you've had that initial full study done, there are two types of updates that can be done after that. The first type is called an update with site visit. So in that case, a new site inspection is taking place, but it's going to be based off of an existing component list. In that case, just trying to identify any significant changes in life expectancies or cost estimates based on the current conditions at that property. There are some states that require these types of updates at specific intervals, but generally speaking, longstanding best practice is to have one done at least every 3 years or so. Okay, the last type of study is called an update with no site visit, which is exactly what it sounds like. Still a whole new reserve study document, but instead of conducting a new inspection of the property, in this case, the provider is just corresponding with the board, with the property manager, to find out what projects have taken place or what new information has become available since the last time anybody was actually on site. Okay, there are two parts to a reserve study, what we call the physical analysis and the financial analysis. We'll talk about each of these. The physical analysis portion of the study, this is the part where someone will be coming out to do that on-site visual inspection of all the common areas, right? Everything from the roof to the mechanical rooms, the amenities, the lobby, anything and everything that the association is responsible for could be evaluated during this process. It involves taking lots of measurements, photos, but also documenting things like model numbers and serial numbers for equipment. Basically doing whatever it takes to gather up the raw data related to each component, which will eventually be used to determine its life expectancies and replacement costs. So when we do this type of physical analysis, usually very helpful, very worthwhile to meet with a representative from the property. That can be a board member, a manager, an entire board, a committee. The idea there is to try and collaborate with the representatives from the property to gain from their insight and their experience of living or working there. Okay, the second part is what we call a financial analysis. And this is the part that takes place back at our office, where we organize all of that raw data that came from the inspection and we start to analyze it, right? This is where we'll research particular costs or project history, compare that information with our experience of working with similar properties. We start to fill in the gaps, start to draw some financial conclusions and start to see into the future about what this property has in store. There are 3 outcomes to a reserve study, which I'll go through one at a time. The very first one is called the component list. Now, the word component in this context really just means an instance where an association will spend money. So a reserve component could be a roof replacement cycle. It could be resurfacing the swimming pool. It could be remodeling the lobby. The idea is that for each component, there are 3 key pieces of information that need to be determined. First, we need to determine the useful life of that component. What I mean there is its overall lifespan, or how long is it going to be in place from start to finish, either from when it was originally installed or most recently replaced until that needs to be done again. The second estimate is its remaining useful life. Now, that number is always going to be determined relative to a certain point in time. So for example, let's say you've got a component with a useful life of 10 years, and as of this fiscal year, it's 3 years old. In that case, you would say that, again, as of this fiscal year, the remaining useful life should be about 7 years, 10 minus 3. Lastly, we need to come up with an estimate for the replacement cost. And we get asked all the time if the word replacement is important here. Does it really matter? So to be clear, you don't always have to be fully replacing something to justify spending reserve money on it, right? We could just as easily say upgrade, remodel, modernize, resurface, or something else. So don't get too hung up on the word choice or the scope of work, right? Instead, keep your focus on the need to spend money to keep that component providing value to the association. All right. At this point, maybe you're wondering, how do we determine what goes on that list? And we talked earlier about the Florida statutes and what they have to say with respect to reserve budgeting. But today we're going to give you a little bit different approach. So most professional reserve study providers will be using this 4-part test, which again comes from our National Reserve Study Standards. Now, the nice thing about the standards is that they give this as an open-ended definition of what a reserve component should be or could be. And the beauty of the test is that it can be applied to any different type of community. So instead of going into a project with some kind of predetermined checklist, we go in with our eyes open, looking for anything there that might meet the criteria. So let's walk through these 4 parts one at a time. Okay, the first part is that the component in question has to be the association's responsibility. It's pretty straightforward. An example of something that might fail that part of the test could be windows and doors in a condo building, right? And we'll circle back to this at the end when we talk about some of the changes in the new legislation. But in our experience, I would say at least 99% of the time, the individual unit owners are responsible for replacement of their own windows and doors serving their unit. So in those cases, there's no need to include them in the funding plan for the community. In the case of an HOA, where your roads are maintained by a city or by a county, obviously there's no need to include funding for road repaving. It's not your obligation. The second part of the test is that the component has to have a limited useful life. So in our world, we don't typically use the word forever, but if something should last indefinitely and there's no timeline where you would expect to replace it, then it really probably doesn't need to be considered as a reserve component. As an example of that, you might think of the foundation or the structural framework of the building or the conduit, inside the walls. These are things that should last the life of the property, however long that is, and therefore you're not actively funding for total replacement. It's much more likely that a developer would come in and buy the building, knock it down, and build something new. That's much more likely than it would be for you to replace those things. All right, the third part of the test, I think, is maybe the most complicated, which is that a component has to have a predictable remaining useful life in order for it to be appropriate to include that in the reserve plan. Now, the key word here is predictable. And to be even more specific, what I mean is predictability in terms of scope and frequency. Okay, if you can't reliably predict how much money you'll spend on something or how often, then it's probably not the best idea to handle that through reserves. And I'll give you a very common example of that. Lots of associations will ask us, can we list the payment of our insurance deductible as a reserve component? Can we put that on our reserve study? Right? It's a really big number. If we ever, have a storm and we have to pay it, that's going to be a big hit to our community. So can we list that as a reserve expense? Now, our response is always going to be, well, what should the useful life be in that case? In other words, how often are you going to have to pay the deductible? Which, of course, is something nobody knows. That's the whole reason why you have insurance in the first place. Those losses, those expenses come as a surprise. It's a result of a natural disaster, a fire, a flood, a hurricane. And to make some arbitrary prediction about how often that might occur is kind of getting away from the whole point of this exercise. Now, that's not to say that we don't recommend you have some kind of plan in place. After all, in Florida, there's always going to be more hurricanes, more storms coming. The problem is that we just don't know how often or how severe those will be. And so there's really no way for us to responsibly tell a client how often they would be paying that deductible. How often does that expense come up in the funding plan? We have no idea. So when that comes up, we'll tell them, look, might be a good idea to have a third account for the association. Guillermo did a great job explaining about operating accounts and reserve accounts, operating accounts being for your routine expenses, reserve accounts for all the things that do meet this criteria. But aside from that, maybe it's a good idea to establish some kind of emergency fund. Could be an emergency line of credit even, that would be available to the community in the event you need to pay for that insurance deductible or whatever that big surprise is. The problem with listing it as a reserve component, again, is that if we're going to be basing some funding calculations off of a timeline of predictable expenses, but one of those expenses doesn't fall in line with the plan, all of the resulting calculations get thrown off, right? So if we just arbitrarily guessed that there was a useful life of 10 years for paying your deductible, we're assuming we'll get a major hurricane every 10 years. But what happens if you get 3 storms in 5 years, right? And you're expecting that your reserve account will fund for those costs for that damage every time. In reality, what happens there is you're going to end up pulling money away from other reserve components that probably did have a predictable lifespan, which more often than not might lead to a special assessment to make up for those shortfalls. Okay, the last criteria on this test, this 4-part test, is does this component represent a significant cost to the association? We showed you earlier that statutory number of $10,000, but again, we think that's kind of arbitrary. In our experience, most associations should be setting that bar much lower. The advantage of doing it that way is that, yes, they will have more components that now meet the criteria and are listed in their reserve schedule, but think about that for a second. That takes the pressure off of the operating budget, which would otherwise have to absorb those costs when they come along. Right. So let's just consider a small association out there. Maybe they have 6 projects that are $5,000 each. Technically speaking, they would be compliant with the statutes if they left those out of the reserve plan because individually they're under the $10,000 number that we get from statute 718. But however, let's say that all 6 projects happen to occur around the same time. Well, collectively, 6 times 5, that's a total of $30,000 that they're now trying to squeeze into the operating budget. And if cash flow is a little tight, maybe they find themselves in a tough situation. They have to cut costs somewhere else or pass even a small special assessment. But if they have those things listed in their reserve plan all along, now they have the ability to spend reserve money on those. Hopefully that's less disruptive to the community. Okay, so the point is there's no one number that is appropriate for any and all associations. The statutes paint a very broad brush. Everybody from 4-unit buildings down in the Florida Keys to a 500-unit, 50-story luxury tower are all under the same statute. That doesn't mean they should all be viewing this the same way. Okay, on this slide, we drew this little red bracket around the top 3 components. These are the only ones specifically mentioned in 718. Again, setting aside the new legislative issues, which we'll talk about. But for all condos in Florida, typically it's just been these top three: roofing, painting, and pavement. Now, you see here a lot of other components that we routinely include in a reserve study, right? Now, we know the statute has that definition, that catch-all part of, anything else over $10,000. But the problem is that most boards, most associations are not always aware of how much things cost, right? So just to give you some rough idea, for a small, simple townhome style community, not too many amenities, maybe there's 15 or 20 reserve components on their schedule. But if we're dealing with a big luxury high rise or some other complicated building, we can have 50, 75, even 100 components that are listed there. All right. Let's talk next about the second outcome, what we call the evaluation of current reserve fund strength, which is what we use, the term or the concept we use to describe this is called percent funded. Okay. So one of the best ways that we found to explain percent funded is using the analogy of a credit score. Okay, we've all had our credit reports pulled. You should all generally have some idea what your score is. And you understand that to an outside party like a bank or a credit card company, your score is an indicator of what kind of risk you are. So in the same way, if you think of the reserve study itself like a credit report, something like that, but you have to distill that down to one key result, we think that should be percent funded. Okay, we measure it on a 0 to 100% scale. We consider anything between 0 and 30% funded to be a weak position. So in that range, associations have a much higher likelihood of special assessments and other cash flow problems. Now, once you get above 30% funded, now you're kind of in this fair, more moderate risk position, right? Not an emergency anymore, but there's still room for improvement. Where you really want to be as a community is above 70% funded. That's where we've seen the lowest statistical risk of those types of problems happening. Okay, so we've talked about percent funded conceptually. Now let's talk about how it's actually calculated. Now it's a fairly simple idea. All we're really doing here is looking at how much money an association has at some point in time, and then comparing that amount against how much money it should have at the same point in time. We're going to express that comparison, right? That number divided by the other number as a percentage. Okay. So the first part of that calculation is pretty simple. When we're doing a reserve study for a client, we're looking at their current financial statements, we're working with their bookkeeper, and we're looking forward, right? At the start of the next fiscal year, how much money will you have in the bank, right? So most of the work we're doing now, we're looking at January 1st, 2024, trying to figure out how much money will be in reserves at that point. The next step is to compare that amount against how much money the same community should have. Now, this notion, this concept of how much money they should have, this is something that we call the fully funded balance. All right, now let me make this part really clear. The fully funded balance is a theoretical number, right? But the way we want to put this in perspective is to ask you a question, right? If I told you that there's some association out there that has $50,000 in reserves, but I haven't told you anything else about the community, is that meaningful? Have I really told you anything at all? And we'll hear this kind of thing all the time from our board members, right? Someone will say, I think we're in good shape. We've got $800,000-900,000 in reserves. And I immediately say, well, first of all, I'm glad you have reserves. That's great. But we don't know if that's enough unless we have something to compare it against, right? And this is where the fully funded balance really kicks in. It all depends on what type of property you're talking about, okay? If we're dealing with a little 2-story building with no amenities, just a parking lot, it might be that $50,000 is plenty of money for them. But if we're talking about a big luxury high-rise building, you can probably understand $50,000 is a drop in the bucket. That might be wiped out in one installment of one paint cycle, right? So that's not anywhere near the same amount of meaningful money for this type of community. Okay, we'll take this one step further. Let's talk about how do we actually calculate that second part, the fully funded balance. Now, this is a fairly, again, these are all, I think, fairly simple ideas, but let's talk it through. We need to look at how old a component is compared to its overall lifespan. That gives us a fraction. We then multiply that fraction by the current estimated cost of the component, which tells us how much money the association should have today for its eventual replacement. Okay, now when you do a reserve study, it doesn't matter if the association has 4 components or 400. We're going to calculate the fully funded balance for each individual item, then add all those numbers together. That will give us the fully funded balance for the entire association. Right? And we're going to do an example of this. So if you're struggling to catch up, don't worry. Again, this is all recorded. We're going to send out the slides, but I just want everyone to get the main concepts now. Once we've done that, once we've estimated our fully funded balance for the whole association, now we have something we can use to examine their cash on hand and make a determination, put that in perspective. So let's run through it. Let's do an example together. Let's all pretend we're on the board of this, mythical condo that we'll call the Seaview condominiums. And our job is to calculate percent funded for the association as of the start of the fiscal year. Okay, so let's say, and again, now that you understand percent funded, the first thing we have to do is establish the starting reserve balance for that fiscal year. So let's say we've done that. We've looked at the financial statements, taking into account any spending that's going to happen this year. We know how much they're budgeting to contribute to reserves, plus this, minus that. We're going to have a starting cash position of $60,000 at the start of the year. The next thing to do is to calculate the fully funded balance for each of their components. And for the sake of time and for this example, we're going to limit it just to 3 things. Okay, so let's say we're talking about the roof, and we'll say the roof is 10 years old with an overall useful life of 20 years. And let's say it has an estimated replacement cost of $80,000. Keep in mind that the fully funded balance is the proportion of that cost that they need to have on hand today. So since it's halfway through its life, they only really need to have half of the replacement cost saved up today, recognizing that there is another 10 years to collect the difference. So in this case, we will take 10 over 20, multiply that by $80,000, which tells us that the theoretical fully funded balance for the roof right now is $40,000. Okay, it's halfway through its life. They should have half of the replacement cost in the bank. Okay. Next example, let's say we're doing the similar calculations for the gym equipment. So if it's 5 years old, right, with an overall life expectancy of 15 years, useful life of 15, and a replacement cost of $30,000, then we know that the fully funded balance for the equipment as of now should be about $10,000, right? Makes sense. It's only 1/3 of the way through its life. So in theory, this community should have 1/3 of the replacement cost saved up. Let's do one more. Let's say that they painted the hallways 2 years ago, and the plan is to do that every 8 years. At a cost of $100,000, we can take 2 divided by 8. So it's 1/4 or 25% of the way through its life. And at that cost estimate of $100,000, we would know that the fully funded balance for hallway painting is $25,000. All right, here's where we tie all this together. We know that the starting reserve balance was that $60,000, okay? And we've calculated the individual fully funded balances for each component, which will enable us to calculate percent funded for the entire association. Okay, so here's the real numbers. Here's the 60,000 starting balance. We're going to take the sum of the fully funded balances that we just calculated for each of those 3 things, add them together, 40,000 plus 10,000 plus 25, we get a total of $75,000. So if we determine that they had 60 and they should have 75, they're 80% funded, right? Not a bad place to be. A little room for improvement, but overall, this community is pretty much on the right track. All right, so before we move on from this section, I want to talk about how we draw some financial conclusions about these communities based on this level of percent funded. Okay, so what you're looking at on the chart here, this is the result of a huge internal analysis that our company did a number of years ago. The way it worked was we looked at a data set of thousands of associations we'd worked with, and we were measuring 2 things, 2 variables. First, what was their percent funded level? And secondly, were they in need of any immediate special assessments as part of their funding plan? Now, the results are pretty obvious, pretty consistent with what we would have expected. Basically, the closer an association is to 0% funded, the higher the likelihood, the higher the frequency that they would need immediate special assessments, right? They have very little money in the bank relative to their needs. As components are reaching the end of their lifespan, the only way to pay for them is that special assessment or a loan, in theory. Okay, a few years later, we did another study. This time we were looking at the correlation between percent funded and property value. So the way we did this one was to look at a really big data set again, but from a concentrated area, right? So this is one metropolitan area, basically greater Los Angeles, California. And the idea here was to pick a group of properties that were all as similar as they could be in terms of their size, their age, their amenities, and so on. We then measured the appraised market value of the homes in those communities to see, is there a difference? What happens when the associations are in a better financial position than their counterparts? To be specific, do we see any increase in property value for associations that are in a better financial position as measured by their percent funded? Okay, so the first thing we did here was to set a baseline, right? And those were defined by the associations that are in this kind of weak position, right? 0 to 30% funded. We then looked at what happened to similar properties, but for those that were in a fair position, 30 to 70% funded. And again, being as equal as possible, what we found was that those other communities, the ones that were in the fair position, the dollars per square foot property value in the fair range were about 8% higher than their counterparts in the weak associations. Now, even more interesting, the ones that were in a strong financial position, above 70% funded, the dollars per square foot appraised value were about 13% higher. Yeah, you can kind of intuitively see how that might be the case. The communities that have money in the bank tend to have better curb appeal. They're in better physical condition. That makes them more attractive to potential buyers. Maybe they have more modern amenities, more updated technology. They can afford to get things fixed when they break, right? So again, if one of the kind of fundamental questions, why do we do this? One answer is that higher reserve funds, higher reserve fund balances, higher percent funded is actually going to lead to hopefully higher property value, all else being equal. All right, talking now about our third outcome, right? The third thing you get from a reserve study, which is the funding plan. Now, we've talked about the first two, which is the component list. That's essentially defining what you're reserving for. And then we talked about percent funded, which tells us where do these communities stand as of this point in time. But now that we know those two things, the final question to answer is, where do you go from here? So one of the first things that we do when we're designing a funding plan is to look at the current budget, right? What happens if they just keep doing what they're doing? What would happen if that played out over time, given their timeline of future expenses? Now, if it's clear that the existing plan will not be sufficient, then obviously we have to recommend some changes. So two of the other points I want to make here, in case you're not aware, the funding of reserves has to be consistent with the timing of your overall assessments. So for example, if you have monthly dues that you collect from your owners, there needs to be a monthly reserve contribution. In Florida, I believe by law, that has to be made within 30 days. And what I'm saying, in other words, is that what you can't do is just operate throughout the year, hoping that at the end of the year, there's a little surplus in the operating budget. You do a bank transfer, pop that into the reserve account and say, yes, look, we funded our reserves this year. It doesn't work that way. It's supposed to be a proactive, ongoing plan. The last point to make on this slide is that, unfortunately, there's lots of cases where the historical contribution rate is not sufficient and the association might be in bad shape. Unfortunately, that might mean there's an initial special assessment that's part of this funding plan. When that happens, and we say this to clients all the time, it's very appropriate to think of the special assessment as not very special at all. It's just the eventual catch-up contribution that's required now because of all the prior years of insufficient funding. It's not a big surprise. It's just the other shoe has dropped. Okay, some of the key principles that come into play when we're designing these funding plans. In the interest of time, I'm going to make this a little bit brief. Some of these are pretty obvious. First of all, when you're designing a funding plan, you have to make sure there's going to be enough money in the budget, right? So when we run this out over 30 years, as we see expenses taking place, as we see cash going into reserves, year over year, there always has to be at least something left over. You cannot design a funding plan that has you run out of money for obvious reasons. You're funding all of your components all the time. Okay, you don't take years off. You don't say, we just painted our building, so we're going to stop funding for painting until 2 or 3 years from now. You're constantly funding everything, no matter where it's at in its life cycle, because the deterioration cycle starts over as soon as the project is done. So you want to make sure that your reserve contributions are keeping up with that timeline. Your contributions should be stable, right? There should be an increase each year. Typically, it's very rare that, especially these days, that costs go down from one year to the next. So you want to make sure that your contributions are stable but increasing. And the last point here I'm going to spend a little bit more time on, which is to be fiscally responsible. All right, this is, I think, maybe the most important thing to follow when we're designing these funding plans. And I want to just kind of shed some light on what I mean by that. So first and foremost, it means being realistic with respect to interest and inflation. Okay, it's just not realistic to assume that you're going to earn 10% interest on your reserve funds. Unfortunately, we know that reserve money just can't be invested in anything very exciting, right? So you should be assuming a reasonable but probably pretty low return on those funds. With respect to inflation, you should also be realistic, okay? Obviously, the last couple of years are an outlier, but traditionally what we found is that through historical data trends, when you spread it out over a long period of time, the average annual inflation rate very reliably centers around 3%, okay? Now, if you're assuming that the cost of a project 15 years from now is the same as what it will cost you today, likely to be way off. That plan is probably not going to work. Okay, the second point on the slide here speaks to being honest about the situation that you're in. Okay, if the association has not historically done a good job of funding reserves, it's time to address that, right? You board members out there, you really want to be careful here. You want to observe the business judgment rule, be clear, be transparent, be honest, wake people up. It is financially irresponsible to continue to operate the way you always have, just to try and maintain some kind of status quo, right? It is not the job of the board to make the owners happy or to keep the dues low compared to the building next door. You have a fiduciary responsibility to your corporation, okay? Speaking of the owners, the reserve funding plan cannot be biased in favor of the people who live there now at the expense of the people who will live there later on. You can't just kick the can down the road assuming that some future group is going to pay the tab for you. Now, lastly, this all takes place despite what may have happened up to now. We see this all the time. Prior budgets weren't funding their reserves appropriately, and the current group of owners has had that can kicked to them. That's not an excuse to turn around, put your blinders on, and kick it down the road for the next group, right? In a perfect world, of course, all associations would have been carefully managed, would have been doing this properly over the years, and should be in a stable financial position. But in reality, that's very often not the case. I just might want to make this last part clear. That does not in any way remove the obligation from the board to act responsibly, fulfill that fiduciary duty, explain to the owners what's going on, help them make an informed decision. Okay. Now, having said that, we of course recognize this is a challenge. If your association has been operating for many years without funding its reserves, there's a great chance they'll be in a financial hole that's going to be hard to climb out of, but you can't overlook that, right? The owners in the community, again, deserve to make an informed decision. Having a reserve study done might be a helpful way to make that possible. They need to know that if the reserves aren't funded properly, the only logical conclusion will be special assessments, will be loans, right? When things need to get done. Remember, going back to the guy we saw in the very beginning with his eyes closed, his fingers crossed, kind of just hoping for the best. If Guillermo and I have done our jobs here today, hopefully you'll agree that that mindset is not a substitute for a responsible financial plan, right? We hope everybody got some good information from this course. I'm going to pivot now, and we'll take about 10 minutes to do a very quick detour over Senate Bill 154. All right, so if you've attended our classes before, particularly since last year, we've said a lot about the legislation that was passed in May of 2022, which was Senate Bill 4D. I'm not going to spend too much time on that, other than to say that that was pretty widely criticized from the day it was passed. And I think very early on, there was talk about a cleanup bill or a glitch bill being put forth. And now we have seen that come to fruition. So SB 154 is effectively the cleanup bill that we and others have been talking about and hoping for a long period of time. This was adopted in this past legislative session, right? So this year's session began in March. It ended May 5th. Right in the first week of May, the legislature adopted this new bill. Initially, it was created by the Senate, but then adopted by the House. And I think it's important to point out by unanimous votes at every step of the way. There was not a single vote of nay against this language at any point in the process. So I think that really says a lot about the quality of the new bill, the consensus that's been built around it. The very final step in this process is for it to be signed into law. So Governor DeSantis will be doing that any day now. I have not heard anybody say that there's even a shred of doubt that this will be carried out. So we, and I think probably to a certain extent, the whole industry is kind of already acting as if this is the case, right? So let me give you a couple of the key changes that are new, and I want to just, I guess, zero in and focus specifically on the structural integrity reserve study requirements. I would definitely encourage everybody to read the bill. It's about 77 pages long. It applies to condos and co-ops that are 3 stories or higher. You can read the actual text by going to, I think it's flsenate.gov. If you search SB 154, it's not hard to find. You want to make sure you're looking at the most recent bill text. There's a couple amendments along the way, so make sure you're looking at the one dated from early May. But I'm not going to spend too much time talking about milestone inspections since that's not really our focus. But with respect to the SIRS, the Structural Integrity Reserve Study, there's a bunch of key changes and improvements that I think we can talk about. So first and foremost, if you're familiar with last year's bill, you would remember that there was about 10 things that were listed there that every property would have to list in their Structural Integrity Reserve Study and fund for, right? So they gave a list and said, everybody must establish a life expectancy and a cost for these things and begin funding for them. And very quickly, people pointed out, how are we supposed to do that for our foundation? Or, what does floor even mean? These were 2 of the things on the list. And I think to their credit, the legislature backed up and said, wait a minute, yeah, that's true. Buildings can't be funding for foundations. They never get replaced, maybe a repair, maybe there's a settlement issue here and there, but that's not a routine thing the way a roof is or a coat of paint is. So they I think wisely got rid of that from the criteria. Same with floor. It went on to further clarify that all of the components to be included in the SIRS are still subject to the condominium or the co-op declaration. So if your declaration states that unit owners are responsible for their own windows and doors, there is no need to include those in your structural integrity reserve study. Okay, so another nice improvement there. Another one, I actually didn't put this on the list, but they also went to clarify that this is for residential properties specifically. So if you have a commercial condominium, what they sometimes call a docominium, privately owned dock that's organized in a condo format, those are excluded. This is specifically for residential properties. Big change here. In last year's bill, it said that the structural integrity reserve study could be presented or conducted by a licensed engineer or architect. The new bill expands that to include an RS, a reserve specialist, or a PRA, a professional reserve analyst. I think that's very important. These are the people that have been doing reserve studies professionally for a long, long time. And it basically just says that, companies like us can do the visual inspection without needing to bring in an engineer or an architect. Some of you who've been reaching out to us and saying you've gotten quotes from engineers and architects for this type of work have been, I think, very consistently shocked at the price tag compared to a kind of traditional reserve study. So this should bring costs down for associations by not having to rely on additional third parties to get this done. Another really major change here, the language in the new bill, basically, I'm kind of paraphrasing here, but it basically states that the provider of the study can suggest that there is no need to fund for components that have an indeterminable life expectancy or cost, or for a component exceeding 25 years of remaining useful life. Big change there, right? So although we still need to consider plumbing, electrical, structure, things like that, it basically gives the opportunity for the provider to say, look, this is still a relatively new building, or there's nothing wrong with it. There's no predictable need for an association to spend money on this thing. They don't need to fund for it right now. So again, a very important distinction between SB 4D, where it said you must include these things and you must fund for them. This is basically much more realistic way to go about this. You don't need to fund for things that really are not, limited or predictable in their lifespan, which dovetails very nicely with our National Reserve Study standards for part tests, which we talked about earlier. Okay, some additional clarifications and little kind of detail wording and stuff in there that, for the most part is, procedural. Attorneys, well, I'm sure we'll have more appreciation for some of those details, but I think the really big picture stuff is here. Now, that's not to say there's, that this is crystal clear, right? There are still some leftover issues that I see here. First and foremost, just conceptually, still calling this a structural integrity reserve study, I think misses the point. Reserve studies are about financial integrity. Okay, so there are many, many things that were not listed in the SERS criteria that are still very impactful for associations. Things like elevators, cooling towers, generators, major mechanical systems, lobbies, amenities, pools, tennis courts, gyms. All of these are really substantial in cost. And if you're only limiting your scope of work and your reserve planning to the things listed in the SERS bill, I think that's missing the mark. Right, a reserve study from a good provider should have much more than that in there, everything that meets the 4-part test we've been talking about. So, again, don't get lulled into a false sense of financial security, thinking that you've done all you need to do if you just limit it to those. I think it's now 8 things, okay? Frequency. The bill still says that you have to have this done by the end of 2024, and then it must be, I should say it's required within 10 years of the creation of the condominium. So if your property is 10 years old or more and you've never had this done, you need to do it. And then it needs to be renewed every 10 years, right? So I think we mentioned earlier in the class that the long-term industry standard kind of best practice is more like 3 years. A lot can happen in Florida in 10 years, right? That's more than a cycle for painting and waterproofing, just as one quick example. Imagine if you're not updating your cost estimates, right? If we compare what things cost 10 years ago to what they cost today, that is not nearly often enough in terms of financial checkup. I think we still need more clarity about how to do the financial analysis and what the implications are for pooled reserve funding, right? So the Florida DBPR does have an FAQ page on their website where they clearly state that pooled funding is still allowed. However, the way I read this, the way it's been explained to me by the bill sponsors themselves, is that they're kind of angling towards having 2 pools of funds. One for your structural integrity components, which cannot be waived or partially funded, and one for everything else that's not on the list, which is more of a discretionary fund. Now, the first fund for everything on the SERS list, again, cannot be waived or partially funded. That's a major departure from how things have been done in Florida for a long time. But you, in theory, could still partially fund or waive for elevators and hallway carpeting and all the stuff that's not on that list. They did make it harder to do that. It is now, I believe, a majority of the total voting interests of the association, not just a majority of a quorum. But that is a nice step in the right direction. So hopefully in the next year, we'll get more clarity about how to put these things into practice. I've heard rumors there's already talk about another cleanup bill for next session. Not nearly as dramatic as this one, but fine-tuning it, making sure that the financial implications are clear. Now, having said all that, I still see a major issue with the time constraints. They did not extend the deadline. It still says that you have to have this done by the end of 2024. I don't think there's really any practical way that there's going to be enough reserve study providers to do this kind of work for, what seems to be about 25,000 properties in the next 18 months. So I think there's a good chance at some point they extend that deadline, but as of right now, that's the law of the land. So that brings us to the end. We're going to kick things over into Q&A. I will welcome Guillermo back in with me, and I'm also going to welcome Paige Showerman. So Paige is our national marketing manager. Couldn't make it for the start of the meeting, but she's going to help us go through the Q&A. So Paige, thank you very much. If you want to maybe start going down the list, and then Guillermo and I can chime in as we get this going. So
you got it. Thanks, Will. All right, looking at the Q&A here, let's go ahead and start with, can a board be held liable for underfunding the reserves after multiple years of special assessments?
Good question. And before I answer, I'm going to give my usual preface. Okay, I'm not an attorney. None of us are attorneys. Some of these questions, if they veer into the legal realm, we may have to say we don't know and recommend that you speak to counsel about that. If you have a very specific question about your particular association's numbers or some detail of your reserve study, if we wouldn't know the answer without having done one for you or spending a lot more time digging into it, I'm afraid we're probably going to have to skip that one as well. We want to keep things broad and general and applicable to as many people as we can. So having said that, the question I think was, can a board be held liable for prior years if there were no reserves recommended and they've had to rely on special assessments? Is that more or less the question, Paige?
Yes, can they be held liable for underfunding the reserves?
So I don't, well, I guess the answer is they could be if I think they were somehow misleading the association, right? So if you have a situation where the board knowingly, intentionally was not observing the business judgment rule, which is kind of a legal principle that talks about them acting in the best interest of the corporation and presenting the data as clearly as they can so that, you know, people can make informed business decisions about it, you know, business judgment rule. If they're not doing that, then I think they could be sued. And in fact, I believe their directors and officers coverage would not protect them from personal liability, right? That is bad behavior by a board. Now, if that's not true, if the board did present a budget that was their best faith effort at a, you know, what it would take to fully fund the reserves, and the association membership every year was documented as choosing to waive that or partially fund it, that's not the board's problem. You know, that's the membership that made that decision. The board cannot choose to waive or partially fund reserves on behalf of the owners. That is only the membership that can do that. So again, that's, you know, every situation is different. There's always a chance a board could be in big trouble. But those are, you know, we'd have to get into more detail to understand that one better.
All right, next question. Isn't the floor and foundation encompassed in the term structure?
It could be, yeah. So the structural requirement, it makes reference to a statute, another statute, I think it's 627, which defines what a primary structural member is. And again, I'm paraphrasing here, but it's basically anything that contributes to the vertical or horizontal structural stability of the building. So yes, I guess you could include those as structural elements in that way. From a reserve study standpoint, I would say that traditionally, when it comes to structural elements, the only things that we would routinely put in are allowances for concrete restoration, right? So if you've got balconies, catwalks, pool decks, columns, any sort of exposed concrete that might develop problems over time, which is very common in Florida, we want to have some reserve money set aside for that. So yeah, technically speaking, I guess, depending on how you read it, those things could be part of the overall structure, but still subject to that, you know, provision where it says if there's no definable life expectancy or cost, there's an option to not fund.
All right. How do you handle an increase in cost halfway through the time period to accumulate the funds?
Well, that's, I guess, speaks to the need to do frequent updates, right? So every year you have to propose a new budget, and every year the reserve funding in that budget should be based on current cost estimates. So if there's been a huge spike in cost from one year to the next, it's time to reset, recalibrate that plan and use the latest information that you've got, right? So if you had, let's say, a situation where you got an estimate for your roof from a roofing company, and the following year you call them back and say what's changed and it's gone up by 10 or 20%, you need to go with that newer, more recent number. Unfortunately, that means your reserve contributions to meet that future expense probably need to go up. So hopefully, if you're doing that often and consistently, you will catch those problems or those changes very quickly and be able to course correct from one budget to the next, not letting it go for 3 or 5 or 10 years at a time, and then only eventually waking up to the fact that, hey, this is a lot different than what we thought it would be. So I hope that answers that one. Yeah.
How will the useful life or useful remaining life be determined for plumbing and electrical?
Well, it depends. Every building is different. And Guillermo, you can attest to this too. When we do a reserve study inspection, there are certain things that we can't see, right? So like what are some of the ways that we look at plumbing and electrical for a building? I mean, and I would say there's definitely a difference between older properties and newer ones.
Yeah, that's what I was about to say. That's kind of unpredictable. You can't really tell when you're gonna have issues regarding to plumbing or electrical. That it's always a good way to go if I mean, the client knows exactly the cost of the project, and let's say they have X amount of lines that they know they need to replace, and they have been replacing 5 per year at a cost of $10,000, or not $10,000, but $1,000 each. We can use that and create an allowance until all of them are replaced, but only in those cases. Other than that, it's kind of unpredictable and doesn't meet the 4-part test that we'll just talk about.
Right. Yeah, exactly. That's kind of what I was thinking too. It's not always and very rarely a comprehensive replacement, where a building will repipe the entire building in one shot. That does happen. And usually when that happens, it's pretty catastrophic. That might be a time when a special assessment is kind of unavoidable. But for a routine building, it's very common that as a building ages, it has more frequent repairs, more costly repairs. The problem, and I'm kind of speaking specifically about plumbing here, is that, as you just mentioned there, Guillermo, it doesn't happen uniformly. It might be one stack of the building is problematic, whereas the stack next to it is totally fine. Sometimes it's the material in the piping goes bad at the same time throughout the building. That can happen, but in our experience, usually it's an allowance, right? It's looking for patterns of repairs, trying to model those patterns into the future, maybe allowing them to increase a little bit, and making sure that there's money going to offset those costs. With respect to electrical components, much fewer instances of buildings having major problems over time. Kind of depends where the building's located. If it's right on the coast and some of the major components are exposed to more rust, they might just fail and need to be replaced. Meter banks on the exterior of a townhome building, for example, those eventually might need to be replaced, whereas a high-rise building where everything's kind of internal doesn't have the same problem. So it really depends on each building, but there's not an absolute one size fits all approach to plumbing and electrical. It's not like a roof where you can always budget to replace 100% of the roof surface. Usually with those invisible things, we can't see plumbing and electrical problems really. You develop partial allowances for repairs over time.
Okay, well, we have a lot of legislation questions. Do you want me to just fire them at you all at once?
Yeah, but and I'm going to say, just for everyone's benefit, we haven't seen these questions before, so we are doing our best on the fly in a changing legislative environment to try to get to these. But yeah, fire away, Paige. Let's go.
All right, let's do it. Can you clarify when the SIRS must be completed by?
Yeah, I believe pretty consistently it's December 31st, 2024. That's kind of the date. So we've got about 18 months now before most communities have that same deadline.
Okay, when is the next glitch bill expected?
So the next glitch bill would be addressed. Basically the lawmakers start in the fall, working on projected plans and ideas for the following spring. The legislative session in Florida, it's a part-time legislature, so they only actually meet for 60 days officially a year. Next year, it's going to be from January to March. So early next year, first quarter of next year is when they will formally meet again, unless there's a special session called by the governor. And that would be when the new glitch bill, if there is one, would be introduced. So stay tuned for that. There may be some rumblings as early as this fall about changes that could be forthcoming, but nothing official would happen until Q1 of 2024.
All right. Who enforces Senate Bill 154?
Yeah, so it's the Department of Business and Professional Regulation, the DBPR, and more specifically within that, I think it's the Division of Florida Condominiums, Timeshares, and Mobile Homes. They're the authority figures. Now, having said that, this is not like the FBI is going to kick in your door if you have not been funding and developed a SIRS reserve plan. I'm very curious to see how a lot of this stuff is interpreted and enforced. I think you're going to have outside pressures, maybe from banks, insurance companies, that might also weigh in and say, before we renew your insurance policy or before we approve any borrowing for your building, we do want to see a reserve study. So it's not just the Florida state government enforcement. I think the market forces will also start to apply here.
When do you suggest we start doing the reserve study to have it ready by the deadline?
I can't speak for the whole industry on that. I mean, we're definitely, getting busy this time of year. We always do get busy in the summer and fall as people are, gearing up for budget season, which usually kicks in full swing by September, October. I guess the answer is as early as possible. I mean, I have heard just anecdotally from some buildings we've talked to recently, they've heard from other providers that they are booked. They are not taking on new work right now and may not be for the rest of the year. This is kind of a major change for the industry. Everybody's a little bit back on their heels trying to figure this out. I think the best thing you can do is start, requesting proposals, start talking with providers out there. This is why we're doing this meeting, to try to get the word out and tell people what's going on. But that's about all I can say. Is the earlier the better. If you've had it done in the last year or two, if you've had a reserve study, there's still a question about whether that will constitute as a SIRS if it included all the important criteria. But there are still some unanswered questions that hopefully we'll have more clarity on and we'll introduce in our webinars later this summer. As it stands right now, I guess the shortest answer I can say is the sooner the better.
Is the visual inspection the same as the milestone inspection?
No, but the milestone inspection can be used, I guess, to support the structural integrity reserve study inspection. I want to make it real clear. The milestone inspection, which we haven't really talked about today, is a structural only evaluation. It is not, does not include anything about plumbing, electrical, fire protection, windows and doors, I guess, unless the engineer considers that structural. That is mainly for the bones of the building, right? The load-bearing walls, columns, balcony decks, things like that. So if you've had a milestone inspection done, or a 40-year certification for that matter, that's very valuable information. You should definitely hand that over to your reserve study provider. But the structural integrity reserve study goes beyond that. It's more than just the structure. So I think technically it does say in the bill that a milestone inspection or a similar evaluation done within the prior 5 years can serve as the visual inspection for the purpose of the SIRS. I believe that language is in there, but in reality, if the client were to give me a 40-year certification that they had done in 2020 and say, here, can you work with this? I would say this is good, but we still need to do our own inspection because there's a lot more to the requirement than just this. Plus, it's a couple of years outdated now. So it can help, but I don't think it's going to be something that most providers would say changes the scope of work a whole lot.
All right. Did you say that Senate Bill 154 applies to only structures over 3 stories?
It's 3 stories and up. So if you're a 3-story building, yes, it applies. Now, part of the law also says that you would have to have a SIRS done for each building that is 3 stories and up, which is another, frustrating problem that they left in there. You can't do a reserve study for one building. It's for a whole association. So if your if your community is comprised of both, if you have 2-story, 3-story, and 4-story buildings, for example, the fact that you have at least one building that's 3 stories or more, to me, means you still need to do a SIRS. It's only if every property in your development is 2 stories or less, I think you're absolved from having to do this. But I'm sure attorneys will weigh in about that too.
How would the 40-year inspection requirement for Dade Broward fall into these new laws, or will it just remain a separate standalone rule with some of the same requirements?
Yeah, so for everyone's benefit who's not familiar with that, Miami-Dade and Broward County for a long time have had 40-year inspection requirements for buildings. And I think it's fair to state that a milestone inspection is taking that concept and expanding it statewide to all 67 counties in Florida. So for most of the state, they have never heard of a 40-year certification. The way I understand it is that they're largely redundant. So if you've had a 40-year certification done, if you've had a 50-year certification, a 10-year renewal, you probably don't need to do a milestone inspection. I would always advise you to talk to an attorney about that, but I think that the 40-year and 50-year and 60-year renewals satisfies the requirement for a milestone inspection. Don't quote me on that. Don't take that to the bank, but the way I read it, I think that would meet the criteria.
Okay. Let's see here. What about if a condominium subject to the CSRS requirement waives their 2025 CSRS reserves prior to December of 24, when must the waived 2025 reserves be funded by? Assume the association will use pooled funding for the 2025 CSRS.
I guess presumably by the following year, right? So yeah, if you waive, and again, we're still learning as we go here. If you waive your, let's say it's October 15th of 2024. Let's fast forward in time. You're looking at your 2025 budget. If you vote to waive or partially fund that 2025 budget, I think that's permissible. I think, but the following year, say you're in October 2025, looking at 26 at that point, I think from then on, you would need to begin fully funding your reserves for those things. Again, that's, some of these things are not immediately clear to me, but that's, if you read the literal text, I think that's what it says.
All right. Is consistent reserve funding a policy rule for HOAs or just condos?
Most of what we've been talking about today is for condos, but if you're in an HOA, there are still statutory requirements that would apply to HOAs under 720. So if your reserves are initially provided for by the developer, or if they're voted upon by a majority of the interest at some point in the community's history, then from then on, you have statutory reserves, which means that you do need to propose a budget each year that shows fully funded reserves and act accordingly, very much like a condo. If it's the other way around, if your developer never gave you reserves and the membership has never formally adopted a reserve model, then it's more discretionary. The board can kind of do what it wants with that money, again, within reason, but it does not operate like a condo at that point. So, again, talk to your attorney about your specific case if you're not sure.
What is the HOA statute which requires reserve contribution monthly if dues are collected monthly?
Well, I believe that would be within statute 720. I know for statute 718 for the condos is where you see that language. I think it's 718.112 is the kind of the general budget section. I believe the language is in there. It could also be in the Florida Administrative Code. But yeah, that's going back to the concept we talked about, where if you have monthly dues or quarterly dues, you would need to have a monthly or quarterly reserve contribution, a reserve transfer. The point there is not to just hope there's some money left at the end of the year and kick that over into reserves. There is somewhere in the statutes, it says within 30 days that has to be done.
We are currently doing pooled reserves for all items. Can we continue with that method, or does the law require us to use the regular method for structural items like roof and painting?
This is a very common question. So the way that we have been told that associations will have to start doing this is 2 pools of funds. You don't need to have straight line or component method reserves for roofs and painting and plumbing and all that stuff. You can still have a pool of funds dedicated to those things. You may also have a pool of funds dedicated to everything else. So there is no need to do this in a straight line component method budgeting format. The DBPR did clarify that. What has not been made clear is if you have one pool of funds right now, how do you break it up into those 2 sections, right? And this is where I'm looking for guidance from accountants about how they would recommend that be done. I think just in order of priority, you would probably fund your CSRS components first because they're some of the most important ones, and whatever is maybe left over, you can leave that aside for your other components. But at this point in time, that's one of the top questions on my list is how do you break up one pool of funds, split it into 2 financial analyses, 2 separate recommendations from the same client. Stay tuned on that. We'll hopefully by next month, we'll have more clarity.
All right. Would it be wise of the association to have a special assessment without a reserve study being done?
Well, I mean, that certainly happens all the time. I think a reserve study is a great way to demonstrate why the special assessment is needed. I think it gives support to a board who maybe is going to anticipate a lot of pushback and angst from the owners about why that's necessary. But it does happen all the time. It's not mandatory that you would have a reserve study done in order to justify it. If you're up against a wall, you've got a major project to do and no time to collect the money otherwise, you don't really have a choice. It's either a loan or a special assessment to pay for that immediate work that needs to get done. Now, if you have a reserve study that backs that up, sure, that's helpful, but it's not a prerequisite, so to speak.
How much can it cost for a reserve study?
It's all over the place. I mean, Guillermo, you see the fees. I mean, there's definitely kind of a bell curve of this. I mean, what would you say is kind of a typical for a first time out, full reserve study that we've never done before for a property?
It definitely depends of the, where is the property located or the size of the property, how many components you've, are there for you to evaluate and measure and stuff like that. But probably, I don't know, from $4,000 to $6,000, that's probably like a safe range for a normal size community, I would say.
Yeah, I think that's fair. Yeah, I mean,
sorry, I just blanked.
For the full study, you mean?
For the full study, yeah.
Right. Yeah,
the ones that is made from scratch, that, yeah. It may change if it's just like an update with or without site inspection. For sure, Correct. It will change, but.
Yeah, when you've had an initial full study done and you have an existing component list established, that's the most expensive reserve study that you probably ever pay for. Further updates to that over the years can be a fraction of that cost. For a no site visit for the same property, it might be a third of that price, right? So it really does depend. It even depends on the time of the year. As I said, there's a kind of a very distinct busy season in our industry, which is the summer and fall. If you're looking to save a little bit of money and you can wait a little bit, maybe call your reserve study provider in December or January after most of their work is done for the year and they're gearing up for next year. That's a little bit of a slow season. So yeah, but I guess the bigger point is that it's thousands of dollars, but not tens of thousands of dollars. And it's not hundreds of dollars. It's, it takes a lot of professional expertise and time to do this properly. And yeah, that's a good ballpark range. Of course, if you visit our website or other people's websites, you can get proposals pretty easily, narrow it down for your individual case.
All right. Is there a statute in Florida that all condos or HOAs are obligated to do a reserve study?
No, not in Florida. Again, 718, and I guess by extension 719, which is the co-op statute, are the only ones that are affected by this new legislation. For 720, for HOAs, there is no legal obligation to have a reserve study done. It's just a voluntary exercise. If you live in a single story or a 2-story condo and you have no 3-story buildings on your property, you are not obligated to have any type of reserve study done. Is it a good idea? Yeah, probably. I mean, that's why we exist, and we've been operating in Florida for a long time before there were any requirements. It's a best practice. It's certainly, if your board is not comfortable developing these numbers on their own, if they don't know what things cost and what to put in the analysis, that's where a good reserve study provider can help you out. But it's not legally obligated for everybody in the state.
All right, we're closing in on our time for this webinar. Will, do you want to take a look at the last few questions and see if you want to answer some of those?
Yeah, sure. I'll skip those over, and if you want to maybe launch the poll, or if I need to do that, I can. Because we are getting close to 2:30, and we want to make sure that we
Yes, I think you need to launch the poll.
Okay, I'll do that now. All right. So again, thanks for everybody still hanging in. We still have over 127 people, it looks like, still here as of now. Thank you for listening in. I hope you're finding this valuable. We just launched a class poll, so it's only got a handful of questions. If you can do us a favor by answering those, we would appreciate it. In the meantime, I'll scroll through. We still have 17 questions, and unfortunately not enough time to address those. So I'm just going to pick and choose as many as I can. Let's see. are separate reserve studies required for each HOA within a community? Well, yes. So anytime you have a separate legal entity that has its own budget, whether that's a separate HOA within a master development, if you have a master association with sub-associations that are within it, every budget could have its own reserve study, right? And that could even mean a multi-condo, right? So if you're in a multi-condominium association where it's one entity, but you have 25 separate budgets, then you would, in theory, need a separate reserve study for each one. Let's see. If a reserve account is way too large, can the board lower the amount they put away? Yes, right? So there are cases where we'll do a financial analysis for a client, determine that they have a ton of money. Maybe they got a legal settlement, or they just, for some reason have accumulated more than they need. If that's the case, if they're running over 100% funded, by all means, they can back that down until that gets back to a more normal level. So yes, it's rare, but that does happen.
It's also, I'm sorry, well, it's also a good approach to use it for capital improvements, or maybe to open an emergency account for hurricane and any other type of disasters. Remember that those are not going to be considered in the reserve study. So
yes,
if you have
great point,
more money, that's another thing that you can do with that money.
Yeah, if you've got more than you need in your reserve fund, I don't think the first move there is to give money back to the owners. I think you need to look at the association as a whole, as an entity, and figure out, what do we need to do here? Do we invest in some capital improvements? Do we put aside that emergency fund in case we have to pay our hurricane deductible? There's lots of challenges that associations have to deal with. If you've satisfied all those challenges, then yeah, maybe you can cut your dues a little bit. You can fund more money in your operating, maybe provide more services to the residents. But yeah, reserves don't always forever need to be increasing each year. Okay, I think that's about it. So we're getting a lot of responses on the poll. Thank you very much to everybody. I'm going to bring this in for a close here. Just a couple of reminders. So later this week, we'll be sending out the slides and the recording of the session today. We will also be sending out the invitations for next month. So next month is going to be our reserve funding methodologies course. If you've attended that one in the past, I would definitely encourage you to still tune in, because we're going to be changing that a little bit. There are some new language provisions in the new bill that make the balloon payment problem go away. So if you've heard me talk about that before, we're going to be introducing that next month, that there's a newer, better way that we're allowed to fund reserves, where we don't have to worry about keeping a level contribution rate. Again, stay tuned. A lot of this legislative stuff is changing on a daily basis. We're looking forward to the law being signed any day now, and we'll update all of our clients as we know more. So again, thank you for attending today. Guillermo, great job. Thank you. Paige, thank you so much as always. And,
thank you.
Everybody else, we will be in touch. So we'll stop the recording and sign us out for today. And we'll see you next time.